Hey everybody, this is Eric Peltier with Citywide Home Loans and Go USDA. This is the third video in my series. Today is October 17th, so you know this is fresh. This third video is all about a comparison USDA versus some other loan products. Let's start right out with USDA versus a VA loan. If you have VA eligibility, you're some sort of vet, and you probably know that you have VA eligibility. If you have that, please go use the VA loan, or I can do a VA loan for you. I do those. There's just no comparison. VA loans are like the Rolls-Royce of loans. There's zero down payment, no monthly mortgage insurance. The VA works really hard to approve veterans on these loans as well. So if you got VA eligibility, run with your VA loan. USDA versus FHA. This is the biggest head-to-head competitor with USDA, so let's dive in. USDA mortgage insurance is lower than FHA's. It's 0.35 compared to 0.85. What does that mean in real terms? On a USDA loan or a USDA home purchase of $300,000, your USDA monthly mortgage insurance will be $87 a month, whereas a $300,000 purchase price with an FHA loan, your monthly mortgage insurance will be $205 per month. So that's about $120 a month difference. And so USDA totally kicks butt on that one. USDA loans are 100% financing, whereas FHA is only 96.5% financing. So FHA loans, you got to have 3.5% down payment. USDA, you got zero down. With USDA loans, the monthly mortgage insurance eventually can go away. There's some details of how long that takes and so forth that I won't get into. But the big thing to take away from this is FHA mortgage insurance never goes away. FHA reformulated that loan product. They don't want to have people on that loan forever and ever. And to discourage that, they're just keeping monthly mortgage insurance on there forever. USDA rates are very similar to FHA, so it's pretty much even comparison when it comes to rates. FHA has an upfront mortgage insurance of 1.75 points, and USDA has an upfront mortgage insurance of 1.0. So that's like 40% lower upfront mortgage insurance. The upfront mortgage insurance on FHA and USDA loans can be rolled into the loan amount. So to most consumers, it's a bit transparent. They're not paying out of pocket for it, but they eventually have to pay it because it's just adding to their payoff, essentially. So why not take the USDA? It's 40% cheaper. FHA has no income limits. That is an advantage of FHA, whereas USDA does have income limits. And if you go back to the second video in my series, we'll talk a little bit about that. And there's a link to the USDA income limit chart. Now let's talk about USDA versus CHFA. CHFA is a Colorado Housing Finance Authority here in Colorado. Where I do most of my lending. They're a big competitor with USDA, so let's talk about that. CHFA rates are much, much higher than USDA. I'm talking interest rates, sometimes half a point, sometimes 3/4 of a percentage point higher than USDA, excuse me, USDA interest rates. CHFA mortgage insurance is higher because it is tied to a conventional loan in most cases, sometimes FHA, but regardless, CHFA mortgage insurance is much higher. CHFA mortgage insurance does go away like USDA mortgage insurance, so we're par there. There's no winner in that case. CHFA does have higher income limits than USDA, so occasionally that's what makes CHFA win out, is if your income exceeds the USDA limit, but you're still lower than CHFA, then you can go. Then your choice then is CHFA because their income limits work for you. So hope that was helpful. If you, your friends, your family need any kind of home mortgage help, I do the whole list of mortgages: conventional, FHA, VA, USDA, jumbo, CHFA, all that. I'd love to help out. Please look me up. Contact information should be somewhere. Thanks.